Aloha everyone, Joshua Hayes at bigwavetrading.com. Wish I wasn't right this weekend, but it looks like the analysis is pretty much spot on. I only wish I had the confidence and conviction to load up on SPY puts here, but I just simply do not because there's not enough evidence that we are definitely going lower, while at the same time there's not enough evidence that we're going to find any highs. So I just expect a lot of chop through the rest of earnings seasons, August, September, and hopefully we can turn out of it earlier than later. But not a good start and not a good follow through on Monday. It seemed at the start of the day we were actually going to rally higher, and I was kind of hopeful that hey, maybe this will just be chop instead of further selling. But as the day went on, it was very clear that that was not to be. The New York Stock Exchange barely fell 0.14%. Volume was also lower on the session, so that's slightly good news. S&P 500, you can see, pulled back again. Volume lower once again, so was slight good news. And same with the SPY. So there is that going for it, is that the volume is not picking up on the big caps yet. Now, I have seen many times, and in my life, back in 2000 and even in 2008, I can remember multiple times when pullbacks and sell-offs started on very low volume, and by the time it kicked off into full gear, volume exploded. And by then, if you're waiting for that volume surge to confirm that we were at a top, it was way too late. So just keep that in mind for now. The lower volume than the session before is good, but still, hey, that's how a lot of pullbacks start that then turn ugly. If we go and then look on the NASDAQ, we can see, hey, volume was lower in the session before, but still 3 days in a row of above average volume. That one color continues to stand out on the above average volume on every index all year long. And it just makes you wonder, when is that floor of share buybacks going to remove itself and this distribution just causes the market to lose that floor? Just makes me wonder. But until it actually does, it's just a thought, nothing more, nothing less. A hypothesis, if you will. The NASDAQ 100, same situation. Lower volume than the session before, but above average. It's not good, I wouldn't think. And then the QQQ, guys, just look at this thing since the January sell-off. Big, big red volume bars all over the place. Where's our tall green volume bars? Guys, I've seen a lot of markets. A lot. I'll remind you one more time. I've backtested to 1880 on the Dow. I've backtested to 1957 on the S&P 500. I've backtested to 1971 on the NASDAQ. I know for a fact we've never seen anything like this, and when you do, it doesn't turn out well. Whenever you do get the low volume rallies and the heavier volume sell-offs, normally it isn't coming with markets hitting new highs. They've happened before in the market, then it never turns well. It's also positive we could chop around and then rally higher, but when the market's set up like this, guys, you just got to be careful. And so on that note, caution is the priority here. It's nice to see some stocks hold up. I mean, it's not all UVE, MHH, CORV, ULH, UUUU. Those are all hitting new highs for me, HLIT, but that's few and far between. It's like like 1 out of every 10 is doing really well. The other 9 look like shit. So I'm not going to even begin to sugarcoat how things look. Things don't look good. So if there's anything else before I move on to the intraday stops, is that the New York Stock Exchange advanced decline line is not breaking down. I don't have that chart up right now, but it's not breaking down. So that is a partial good news. If that would already be breaking to new short-term lower lows, intermediate-term lower lows here, I'd be 100% certain this market's going to, crap the bed. But for now, hopefully it's just chop. We'll see. Now here's the intraday stops. Told you I was going to go long a SPY put for a swing trade. I settled on an in the money 285 put. Gave myself at least almost 60 days, 2 months out in September playing the weak August and September seasonality, risking the July, January highs in the SPY. Worked out immediately. Finished the day, I believe, up right around 17, 18%. Intraday, it was up 25%. But more importantly, the trade I didn't take, because the damn market rolled over way too fast for the real head and shoulders pattern to develop. And by the time it did pull back to the downtrending 10 and 20-day exponential moving average, it only hung around there for a few seconds. You'll see on your 30-second 1-minute price bar, it hit that downtrending 10, 20-day moving average, but that was only for a few seconds. No time whatsoever for me to get my at-the-money 281 intraday weekly SPY put off. Had I been able to do that, I would have been looking at a 75% plus gain. That damn at-the-money 281 put moved 125% intraday. No setup for me. So now with that out of the way, you can see here tons of stops on that page, but boom, a full page down, tons of stops here, and there's still room for a whole nother page. Now, it's a ton of stops. The commissions are costly, but I will remind everyone the commissions are shit compared to my total account value in this portfolio. It's better for me to have 10 trailing stops than one big stop much further down, and risk paying an extra $9 in commission and losing an extra $200 in capital by being illogical with the stops. So I'd rather be logical and rational, have a ton of sell stops, profit stops, and lose less money when I am wrong. So once again, with these stops, the one thing that's consistent for the entire period since we've been selling off recently starting last week, large profit stops, medium profit stops, small profit stops, tiny profit stops, flat, tiny losses, small losses. Very, very few medium regular size losses based on the initial risk, inherent risk from new long positions. Those are all on recent new long positions, and very few have hit that normal loss amount because I've been raising stops so quickly. That being said, basically everything new is failing. So you have to continue to be careful out there. I am not yet convinced we're done. All hell's breaking loose. Bear market coming up. I don't know if we're going to chop around, sell off, rally. I don't know. I just know that the market doesn't look good here. All it takes is one big, huge kick save, and we're going back up again because the yield curve's not inverted. We have that floor share buybacks. So a signal is a signal is a signal. I'll just be careful with my capital. On that note, there are I'm going to use this term for the third time in this video, shitload of sell signals today. Please go to the new positions page to look at them there. If I go over them right now, this video lesson goes from about 12 minutes to 30 to 35 to 40 minutes. So now, with that being said, let's move to the long positions. One new long position, one long add signal, two new hedges. Really quick to run through the longs first because they're not priority. FCN showed up in my Can Slim Perfect Speculator, new 52-week high on volume and price volume Bob Surge scan along with my tertiary scan. 1, 2, 3, 4, 5 scans. That's way too many scans to make, and it's an earnings winner. So I got to go long just in case FCN bucks the trend. If FCN doesn't work out, I'm going to get long 1% of my count capital at 77.03. Normally this would be a 2% plus position, only 1% since it's extended. 77.03 the close instead of the high of the day. First cut loss right there, 73.12. Final cut loss gap build 79.25. I would rather take this long, have it fail on me, cut my losses, move on, be like, what are you going to do, than not take this trade and watch it run over 100 or to 100. It's bucking the trend of a bear. If this market turns here, this one's definitely going to lead. So I got to get long FCN 1%. If you're looking for everything to be lined up in the market to be going long, if you're a new trader, do not take this trade. Educational purposes only, based on a madman that runs his personal largest end-of-day trend following account like a hedge fund manager. So keep that in mind with FCN. Also, IMMP, perfect speculator quality. BOP is falling a little bit, but it's a high green. It's basically consolidating right. Basically gave me an add signal 2 sessions ago, but since it did as much work at the top part of its intraday range as the bottom part, I passed on it. So today is a legit ad signal as far as I'm concerned, but it's an ad signal only in the perfect speculator scan. So instead of 1%, that'd be 0.5%. And since it's less than $5 a share and the market's downtrending, got to reduce it in half again. So 0.25% of my account capital, about $1,250 into IMMP, limit order 260, first cut loss 230. Then I got 2 hedge signals. Dog in my ETF scan, confirmed in my price volume BOP surge scan, and SKF in my ETF scan. Would have been confirmed in my price volume BOP surge scan, but it's thin. So tertiary scan counts as the same thing for me with the ETF. 2% of my account capital into SKF, 2% of my account capital into Dog. You could do FAS if you want to, or FAZ if you want to. You could do FAZ or you could do SDAO if you want to. But for me, a signal is a signal is a signal is a signal. And these were the 2 ETFs that trigger the signal. So these are the 2 ETFs I'm going to go long. Now I'm listing SKF as a new long position, but I took an initial position in this one back here, holding it for my final cut stop loss right here as a hedge against this weird V-shaped market hitting new highs. So SKF for me is technically an ad signal, but this is a new signal overall. If anybody went long back here, there's probably 0 chance in hell you're still long. I was always working with those lows right there. So I'm adding to my position, but it's basically a brand new trigger signal. But SKF, 2% of my capital, limit order 1925, first cut loss 1886, second cut loss 1881, right? And then final cut loss 1860 on SKF, but it's here, here, and here for SKF. Might be 4 levels, I'm not quite sure, but that's what I wrote down, so there just must be 3. And then Dog has one here, one here, one here, one here. 4 levels to work with. Limit order 57.52, first cut loss 56.84, second cut loss 56.66, 55.96, 55.39. Also forgot to mention that SPY put that I bought that was 15 contracts, total dollar cost amount right around 2% of my capital, because that's normally the size of new hedge positions. So that's how I came to the final conclusion to do 15 contracts on that SPY put. I wanted to invest basically what 2% of my current account capital would be in a new long position, which is right in this account, which is right around $10,000. All right, everyone, we're going to wrap it up there. I don't know what's in store for the market. I just know that seasonally, terrible time to be trying to buy stocks here. Terrible time to be bullish here. That's all I know. So that's how I will operate. Hedges, hedges, hedges until more and more long positions fail, less and less long positions trigger. Then the hedges become outright short positions. And then we'll wait for a bottom, better signals. Remember, as this market starts to crash and crater, if it does, guess who won't be panicking? Guess who will not be freaking out? Guess who will not be telling you the sky is falling, there is no bottom, grab your wife, grab your children, run for the hills? Not me. The market's always bottom. Index is always bottom. They're self-correcting organisms. It will happen again. The market will find a floor and rally, and better looking chart patterns will develop. Stocks like FCN and IMMP will survive the sell-off, and better signals will occur where I can place larger amounts of capital with confidence and conviction. Right now, it's August and September. Good time to be in cash.